Welcome to your market brief for the week of April 6th. As the coronavirus crisis continues and as markets remain volatile, let's get ready for the week with Jim Rogers. He's chairman of Rogers Holdings and co-founder of the Quantum Fund. Moments ago, he joined us from Singapore, where he discussed his concerns about debt and why there's still more pain to come for U.S. markets. Watch this.
In my view, I don't know what the letter is, but we're going to have a rally. We usually do. But then the worst is yet to come because the damage is terrible. A huge debt has been added to a lot of places. Costs are going up for a lot of people. And so we're going to have a really serious recession down the road, and that's going to be a mess for a lot of us. We haven't seen the end of this. I've never seen in my life a recession that cleans out the economy in 90 days. Life just doesn't work that way, at least it never has. In times of turmoil, people look for a safe haven. The US dollar is not a safe haven. We're the largest debtor nation in the history of the world. But people think it's a safe haven, so I own a lot. It's going to go up during all of this turmoil. It's going to get overpriced. It might even turn into a bubble. If it does, I'll obviously have to sell my US dollars. I have bought gold and silver starting last summer. Didn't buy gold and silver for several years, but I have bought gold and silver. Sugar's down something like 75 or 80% from its all-time high. We're not going to stop using sugar no matter what. So there's certainly opportunities out there for people who want to pedal around and find something to invest in. And I want to repeat about the US dollar. You know, the US dollar is a terribly flawed currency, Caroline, but everything else is more flawed. And when people get panicky, they look for what they think is a safe haven. So I own a lot of US dollars.
And just quickly, what's your take on the recent plunge in oil prices and the fact that they could go lower?
Oil, we're going to look back in a few years and see that oil has been making a complicated bottom. We're going to see that in 2015, 16, 17, 18, 19, 20, 21, 22, because, you know, the known reserves of oil are in decline, except for fracking. But now we know the fracking bubble has burst. It used to be if you could spell fracking, people would write you a check. Now everybody knows, wait a minute, these guys have to make money. So the fracking bubble has popped. So we're in the process of continuing to make the bottom. Part of the reason the bottom may not have been made yet is because demand is down. And whenever you have a recession, demand goes down. So when demand goes down, that hurts the price too.
Shifting to a preview of the coming week, the Wisconsin primary will happen on Tuesday, which a federal judge declined to postpone amid ongoing virus concerns. Taking a look at the economic calendar, we'll get data on U.S. employment and consumer credit, as well as a rate decision from Australia's central bank on Tuesday. The BLS releases the producer price index for March on Thursday. We'll also receive another crucial reading on the labor market with the weekly claims for unemployment insurance on Thursday. And the U.S. equity and fixed income markets will be closed for Good Friday. Let's continue to maneuver this challenging market with Sylvia Yeh. She co-heads the Municipal fixed income business for Goldman Sachs Asset Management. We recently discussed the impact the coronavirus has had on the muni bond market. Watch this.
The muni market in particular is challenging. And in some cases is going through an ongoing price discovery process. And that's particularly difficult for investors in our market who have really enjoyed, or just coming off of a year, a very strong performance. Outflows are also something that's probably going to continue for us and something that we need to keep an eye on with the volatility. And it'll be interesting to see if these outflows are permanent departures from the asset class or just a result of rebalancing into equities and other risk assets that people have been waiting to do for a really long time. There's a positive to all of this, which is nice. And that is that buyers are actually back in our marketplace. On the back of tax reform, we actually lost a lot of buyers. And that is due to just munis not being as valuable as they once were. And those buyers include insurance companies and banks, and they've come back in now that our rates have gotten more attractive to them. Further, the hedge funds are back in, which is nice to see an alternative buyer continue to have interest in our market. In a nutshell, I think munis just backed up way too quickly and then dropped in a similar fashion, which is just not healthy for our sleepy market. It's something that we're not used to. And if you just look at one data point, which would be the 10-year AAA muni, it rose 200 basis points in a 2-week period and then fell 145 in a 3-day period. That doesn't really happen. So we are expecting this volatility to continue. But we do believe it's a liquidity-driven event for right now and not credit-driven. And I think that basis has to do a lot with the fact that the liquidity landscape for munis has changed. And we've heard this a lot lately with traditional liquidity providers, their motivation and their behavior changing. So as investors, we're going to have to change too. We're going to have to adjust. We've been spoiled for a while, and redefining the market's not necessarily a bad thing, but it makes the importance of professional management that much more relevant.
I want to ask you about the moves of the Fed they've made so far, and really in many ways are designed to help the broader bond and treasury markets operate more smoothly. Are they having success there?
I gotta say, I'm pretty impressed. In the financial crisis, we didn't have this. Maybe it was because they erred on the side of caution in 2008. Maybe we waited too long. It's easy to say that now versus then. But the action by the Fed is really unprecedented on the liquidity side and definitely gave our market some confidence. There's no silver bullet that will fix everything, but there is a willingness there to fix things. And we didn't have that in 2008. And then I look at the fiscal response too, whether it's policy or the stimulus that we've seen, and I joke, say what you want about politics, but we have 3 bills and more to come. And the neat thing about all of this is they're talking about munis. They're recognizing the importance of the state and local governments. They will not let the backbone of this country, America's infrastructure, fail.
My thanks to Sylvia Yeh with Goldman Sachs. That concludes today's Market Brief. I'm Caroline Woods. Thank you so much for watching. I hope you stay healthy and stay safe.